Hello everybody, today we're going to walk through a quick video that shows you ratio analysis, and we're really going to look at operating performance measures here. We're going to lots of different operating performance ratios we're going to look at 5 in particular, but let's first understand what operating performance ratios are really all about. Operating performance ratios are really here to measure how efficiently the firm uses its resources. Okay, so how well is the firm using its assets? What sort of generation is it getting back in terms of return of those assets? And really a measure of how efficiently the firm's managers are in terms of operating the firm itself. So operations in terms of how well we're able to return profits, return positive cash flows to the firm, and really this is going to come down to how well managers are really managing its operations. And here, typically, we have to understand when we use ratio analysis, we're usually going to use this in terms of comparison. So we want to be able to compare apples to apples, oranges to oranges here. So it's important whenever we think about ratio analysis, we always want to either compare to a competitor within the industry, or we can compare this against its historical performance. But important to always have that in mind. We always have to have some sort of indication that, hey, we're going to use these ratios to evaluate a firm, but we have to be comparing this either to its historical past to see how well it's either done, gained or lost traction, or potentially compared to its competitors. So let's look at 5 different ratios I have here. And again, there's more ratios in this in terms of operating performance ratios, but we'll look at these 5 and digest these 5. The first one I have here is the gross profit margin. And so you can see in the gross profit margin here, the equation looks like the revenue minus the cost of goods sold over the revenue. So what does this tell us? Well, this really tells us how much the firm is able to generate in terms of profit for $1 of revenue that they've sold. So, this is a pretty good indication of the efficiency of management in terms of turning over some of their company's goods at a profit. The higher the gross profit margin, usually the better. But again, it doesn't give us the complete picture of profit because we're only taking or adjusting here for the cost of goods sold. In the second ratio you see here, this is the net profit margin. So here, this is evaluating, well, for every $1 in revenue, how much actual profit was I able to generate from that? And so now this is not only going to take into account, well, the cost of goods sold, but this is now also going to take into account other expenses such as taxes, etc., in which the company obviously is going to have on their books. So the net profit margin is obviously going to be lower than the gross profit margin because this profit on top is going to be less than what we see here in terms of the gross profit. But here again, just measuring how well the firm is able to create profits for each $1 of sales they have in their revenue. So let's do a quick example. So let's say the gross profit margin for a firm, we won't do the actual calculation. We'll just put here, this equals, let's say this equals 20%. Okay, so this came out to be 20%. Well, what does that suggest? Well, for every $1 in revenue, we were able to generate 20 cents of that in terms of gross profit. Now, if we come down to the second one, net profit, the net profit is always going to be less than the gross profit margin. So here, the net profit margin, let's say this was 5%, which suggests that after taking into account all the other expenses on top of the cost of goods sold, taxes, etc., now all of a sudden we have a 5% return in terms of net profit. So that's $5 we're able to generate and actually put in our pocket for every $1 of revenue that we're able to generate. So these two measures, obviously, you've probably heard of these gross profit margins and net profit margins, but these are still pretty good measures in terms of how well management is actually able to produce profits. Now, a quick thing we should say here about all these different ratios is that all these ratios are based on accounting numbers, right? So accounting numbers can be sometimes skewed depending on how companies are accounting for some of their cash flows, etc., within their firm. So we have to take that with a little bit of grain of salt, but still we're able to compare this either to its historical past or to relevant competitors to get an idea of how well management is really managing their operations and able to produce profits to shareholders. The next two here we'll look at, again, very common ratios. We'll see we have the return on equity and return on assets, ROE and ROA. Both very, very common ratios that we see across pretty much all industries. And here, this is really the return on equity is really a measure of how well the shareholders fare during the year. Okay, so at the end of the day, this is a bottom line measure, and this is really saying, for every dollar in equity, how much did the firm generate in profit? And again, we have to take this in terms of a little asterisk there in terms of accounting terms. But so we're going to take the net income of the firm over the year. So that's the profit divided by total assets, right? So again, this is saying that hey, if we did this calculation and this calculation came out to, let's say, be 14%, okay, this is really saying that company ABC generated 14 cents in profit per $1 in equity. Okay, and so this should actually be equity instead of assets. This is equity, return on equity. Okay, so for every $1 in equity, we were able to generate 14 cents in profit. Now, same thing in terms of the return on assets here. So in return on assets, we can see that we have same thing, net income over total assets now. And so here, this is a measure of profit per dollar of assets. So let's say we did this calculation, this came out to be, let's say, 10%. This would be suggesting that for every $1 in assets that the company holds on their balance sheet, we're able to produce 10 cents in terms of profit or in terms of net income. And again, just like I said earlier, we have to take this with a grain of salt. These are accounting measures, but again, we can use this to compare and contrast whether from the firm from year to year or from quarter to quarter, or also from a competitor within the same industry. The last one we have here is the inventory turnover ratio. And so here within the inventory turnover ratio, we have cost of goods sold divided by inventory. So what is this? It's going to measure the number of times a company's inventory is turned over within the year. So we can also express this in days. Okay, so here you can see a little asterisk here. We can also represent this in days. And so that's going to be shown here in the subsequent example. So a high turnover ratio, so a high ratio here in this cost of goods sold over inventory is usually considered good, right? So this usually means that the company is able to, turn over their assets fairly quickly. And so if we had, let's say this was equal to 3, so we had a 3 there in terms of inventory turnover ratio. This is really suggesting that the company is able to, turn over their inventory, 3 times in a year. And so the higher the better, because here this means that, we may not have to be carrying this huge inventory compared to our competitor that may have a much lower turnover ratio, which may indicate that we may have less cost in terms of managing this inventory. So if we did it in days, we just take the 365 divided by this ratio we just calculated here, and this would give us our turnover in days. And again, this ratio here, we want a ratio that is smaller, right, in days, because it says, hey, we're able to turn over our ratio every X amount of days, which the better we're able to turn over our inventory, it means that we may have less costs associated with some of those inventory metrics and may show that managers better able to manage their inventory and some of their short-term constraints there. So that's a quick rundown of operating performance measures. There's lots of other different measures we can look at, but these are some of the most popular ones here. And I hope you at least gain something in terms of the different interpretations of some of these operating performance ratios. And if you do have any questions, you can leave them in the comment box below, or you can give me a thumbs up, and I appreciate that also. Thank you.